Hello, everyone. This is Mbrotherton with 1752 Financial, and we're here today to do another one of our quarterly webinars. Obviously, there's been a lot of ups and downs this year, but thankfully, the market seems to have corrected some so far. And as we progress, it's always good to have these touch base points with everyone just to give more information about the markets. Today, we have Ali Company here to discuss the benefits of dividend investing and that process. And I really appreciate them being here today and taking their time out of their schedules. And I'm going to turn it over to them to start the presentation. And obviously, if there's questions along the way, just please let me know. Feel free to use the chat button, and we'll answer those questions at the end. So thanks again, guys.
Thank you, Matt. I'll kick it off here. Hello, everybody. My name is Justin Stender, and I'm the Director of Business Development for the Alley Company. First off, just want to say it's a pleasure to be here. I'm joined here today by Tom Van Buren, who's a portfolio manager from the Alley Company, as well as RJ Diacona, who's an investment analyst with the Alley Company. And we will be discussing with you here today the benefits of dividend investing. First off, just wanted to give you a brief background on the firm that we represent, the Alley Company. The Alley Company is an investment manager located in Lake Forest, Illinois. Lake Forest is a northern suburb of Chicago. The company was founded by Steve Alley back in the 1990s, and we have a very strong and rich investment heritage and investment history. Now, Steve Alley is part of the portfolio management team, the investment team. What's great about that team is we haven't lost anybody. There's been zero turnover. We've only grown and expanded that team over time. With that continuity of the portfolio management team, our philosophy and our approach have been very consistent, very disciplined over time. Other tenured members of the investment team are going to be Rick Duryea, who's been with the firm since 2005. Tom Van Buren, who's joined us here today, has been with the firm since 2014. Then RJ Diacona has been with the firm since 2023, and he's also joined us here today. So our firm has a lot of expertise and experience in dividend investing, and we manage a portfolio called the Alley Company Dividend Portfolio, which has been around for 20 years. And with this portfolio, we really seek to achieve a balance between an attractive dividend yield and strong dividend growth by investing in high quality companies. If you do need additional information on the Alley Company Dividend Portfolio, please let Matt know. With that, I'm going to turn it over to Tom Van Buren to lead our discussion on the benefits of dividend investing.
Thanks, Justin. As Justin mentioned, we have been dividend investors for the past 20 years since we started the Alley Company Dividend Portfolio. And I always love to start our presentations with this quote. It's a little bit extreme, but you get the point. John D. Rockefeller was one of the great capitalists of the US, and he said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." We couldn't agree more in running the Alley Company Dividend Portfolio. It's a tangible return on one's investment. So Justin, if you can go to the next slide, that'd be great. Stepping back a second here, what is a dividend? I think a lot of investors out there hear the word dividend, but might not be totally familiar what a dividend is. At a very simple level, a dividend is when a company shares a portion of its profits with investors. In order to have profits, a company has to have revenues that exceed expenses during a given year. Now, a company with those excess profits can decide to reinvest in the business, they can pay down debt, they can acquire other businesses, or they can return it to shareholders in two different ways. They can buy back their stock, or they can pay a dividend to shareholders. We at Alley Company love those dividends coming in the door. One thing I'd point out here on the bottom is that dividends are no guarantee. So dividends paid to shareholders are at a board's discretion. They can be maintained, increased, or eliminated based on the health of the underlying business. Our role here at Alley Company as portfolio managers and analysts is to decipher great companies who have a dividend that we believe will be growing in the future. We always want to be investing in companies that have a solid and sustainable dividend. Justin, if you can go to the next slide. All right, so what are the appeal of dividends? The number one thing that I want to point out here is that dividends really matter. If you go back in time since 1926, an amazing amount of return has come from dividends. It's approximately 40% of the return from the S&P 500 has come from dividends. A couple other things that we'll be highlighting during our conversation here today is that dividend-paying companies often have favorable fundamental attributes. There's the potential for lower volatility risk, and RJ is going to get into that in his slides. There's also dividend growth over time, and what can be at the end of that is a really compelling yield on cost. And we're going to go through the example of Warren Buffett and his investment in Coca-Cola to show that power of dividend growth. And then lastly, dividend growth can be a really strong hedge against inflation. If you look at the Alley Company dividend portfolio over the last decade, the average dividend growth rate for our companies has been 8% in the portfolio. If you think about inflation over the last decade, it's been about 3 to 4%. So a very nice hedge against inflation. Justin, if you can go to the next slide. All right, I just previously mentioned how much dividends matter when it comes to total return, but this can really spell it out over the decades. So this is data going from 1926 through the end of 2025, again, showing that 40% of the total return comes from dividends. If you look at the bar chart here, the navy blue bars are dividend returns over the decades. You can see it's positive in every decade, whereas the lighter blue is price returns from the markets. And there have been periods of time where markets have been negative on a price basis for an entire decade. If you look at the 1930s here, the Great Depression, dividends were up 5.2%, but price return was a negative 5.3%. So dividends really mattered a ton during that tough market. In the 2000s, dividends added 1.8% for investors, but price return was a negative 2.7%. Again, a period of time where dividends really played a big role in returns. Now, there are other times, such as the 1990s, where price returns were outstanding. We had technology stocks doing extremely well, and they kind of overshadowed dividends. But the key point here is that dividends really matter. You can see every year dividends are getting paid out to shareholders. So it's a steady stream of income for investors. Justin, if you can go to the next slide. All right, the compounding power of reinvesting dividends. This is some amazing information here. 1984 to the end of 2025. On the far left, if you invested $167 by the end of 2025, that $167 invested in the S&P 500 index would equate to, on a price basis, $6,846. Pretty compelling. During that time, investors would have received dividends. They could put those dividends in their pocket, they could spend them, or they can reinvest them. When those dividends are reinvested, the returns are ever more compelling, and that $167 grows to $16,949. So that really illustrates that power of reinvesting dividends over time. Justin, if you can go to the next slide. All right, the power of dividend growth. I told you we were going to give you an example. This is Warren Buffett and Berkshire Hathaway. Between 1988 and 1994, they purchased 400 million shares of Coca-Cola. They bought 10% of the shares outstanding of Coca-Cola. It cost them $1.3 billion to acquire 10% of Coca-Cola. The chart here shows what the dividends paid out to them on a yearly basis and kind of that growth. So if you look in 2004, at that point in time, Berkshire Hathaway, from their Coca-Cola investment, was receiving approximately $200 million in dividends from that $1.3 billion investment. Amazingly, as we fast forward to the end of 2025, they are now receiving over $800 million from that original $1.3 billion investment. It's an incredible story of just the power of compounding and dividend growth, but they are getting 63% back from their original investment. It's almost like owning a bond in some ways of that 63% yield from that original investment. So really illustrates the power of dividend growth and patience and shows that benefit of dividend investing. I'm now going to hand it over to RJ D'Ancona to talk about where we find the best dividend payers.
Thanks, Tom. So on this slide, we have data that highlights the importance of being selective within the broad universe of dividend stocks. What we did was we took a look at how different portions of the stock market performed over a long time frame. We first broke the US market data into 6 buckets, and from those stocks that yielded the most to those stocks that paid no dividend at all. We then analyzed the data for each bucket going back to 1928 through the end of 2025. And what the data shows is that while all buckets produced strong absolute returns over the long term, the buckets that had the best returns on a risk-adjusted basis were those near the middle of the pack. And those yielding the most, or those with little or no yield at all, were much more volatile and generally had lower returns. If you'll flip to the next slide, Justin. So digging a bit further into the source of this volatility, we took a look at that same data stretching back to the early 1900s, but focused in on periods of market stress. So in particular, months where the broad market was down more than 3%. And in those months, the highest yielding and lowest yielding buckets, or the bucket with no yield at all, consistently underperformed during market sell-offs. And we believe this further shows where investors should look for dividend stocks within the market. And if you'll flip to the next slide, Justin. So now that we've kind of narrowed in on a hunting ground for dividend stocks, it's our belief that it's important to narrow things even further and focus in on the highest quality companies. And how do we define quality? So it boils down to a number of factors. Quality companies have stable earnings and cash flow streams over time. They're market leaders and have competitive strength within the industries they operate in. These companies have sound balance sheets with relatively low levels of debt. They also have management teams that have proven themselves capable through a variety of market cycles. And on the other side, we define low quality stocks as having the exact opposite of these characteristics. If you can flip to the next slide, Justin. So we want to summarize some key points that we hope you take away today. When you think about what dividends are, they are just a way that companies share a portion of profits earned during the year with investors. And when you invest in companies that consistently increase the profit share that is being paid out to investors over time, this can be a powerful force that helps you maintain purchasing power as well as grow wealth. Also, dividend-paying stocks, and in particular those that are high quality, can potentially protect capital during market downturns. And over the long term, the risk-adjusted returns of dividend payers have been very attractive compared to the rest of the market. And with that, I'll pass it back to Matt.
Cool, that's great. Thank you. That was wow, it was a lot of great information in a short window of time, and it's really impressive when you think back to the consistency of buying one of these dividend funds or dividend companies that really grows over that 5-year, 10-year, 50-year period of time. So if Buffett's doing it, it's probably not a bad idea. We did have a couple of questions did come in. One of them was what role can dividend paying stocks play in a portfolio? And even to maybe take it a second level on that, is there, obviously we can't put everything in one bucket of money. Is there a percentage that you all recommend that somebody should have in their portfolio?
I can take that one, Matt. Yes.
Okay.
So the role that dividend paying companies would play in an investor's portfolio would be you are getting stock market exposure, so equity exposure, right? But in a more conservative way. So if you look at the track record of dividend paying companies, returns tend to be smoother over time rather than maybe that roller coaster, right?
Okay.
So it's just a consistency and one of the factors of that is that consistent dividend year in, year out, where it really just gives you that more consistent ride per se. They're also great for client or investors that do need income too. You do have to be able to take on the stock market exposure, right? These are stocks, but for clients that do need income, it is a pretty good solution as well too. And as it pertains to the second part of the question, it does really depend on the investor, what they're trying to accomplish. The one nice thing about a dividend-oriented portfolio would be it does tend to be more of a core holding. So it could potentially be a larger percentage of your overall stock exposure because of that consistent return, because of that risk management that dividend paying companies do inherently have.
That's interesting. Yeah. Another question we had was, are dividend paying stocks only a good fit for people at the retirement age? Or is
Matt, I
this
can,
something for you younger folks?
yeah, Matt, I can take that question. And
Okay.
it's a really good one because I think there's a common feeling out there that, oh, dividend paying stocks are just for older people. They're living off their dividends, that sort of thinking. But if we go back to those charts and you look at the compounding power over time, dividends are really for everyone. And they can be even compelling for young folks who want to own a company that's growing its dividend over time. That Coca-Cola example is pretty compelling. So we wouldn't say it's just narrowed to just the older generation nearing retirement. We think it can play a role in every client's portfolios.
Yeah, and I would tend to agree is, having that, we're never going to time the market. We never know if international or small cap, mid cap's going to do well every year, but knowing that we're going to get a consistent dividend in somebody's portfolio is a nice way to balance out that growth. The last one we had was, what is the number one mistake that you see dividend investors make over time?
Thanks, Matt. I'll take that one.
Okay.
So definitely, without question, reaching for yield, I would say, is the most common mistake dividend investors make. So at first, the headline yield might appear extremely attractive, but often it's an indication of a low quality company, kind of the opposite of the higher quality stuff we talked about earlier. These companies might carry a lot of debt, have earning streams that kind of fluctuate or move around quite a bit. And because of these factors, when the economy hits a rough patch, which it inevitably always does, these companies are much more likely to cut their dividends. So that high income that appeared so attractive at first ends up being much lower during those times.
Gotcha. That makes sense. Yeah. Just really trying to time it. So that's good. No, that's great. I think that was all the questions we had today. But once again, really want to appreciate all the time and energy and attention to detail that you guys gave us today. Super great information. I'm sure the clients will have follow-up questions. And obviously, for all the clients, if you do have questions, you have concerns, you want to talk about this solution to adding it and how it impacts your portfolio, please just reach out, let me know. And if you have any specific questions about dividends and how those work, to get more clarity, I'm here for you. So I appreciate all the time and energy, and I guess we'll end today's webinar. So thanks again.
Thanks,
Thank you.
Matt.
Thanks
Thank
a
you.
lot, Matt.
Thanks, guys. All right, bye-bye.